In a jaw-dropping turn of events, financial markets were thrown into chaos this April when sweeping tariff changes were announced, then partially reversed, creating both massive losses and stunning gains. The timing of these policy shifts and who might have known about them in advance has raised serious questions about potential insider trading at the highest levels of government. On April 2nd, a historic tariff announcement imposed a 10% baseline on virtually all imported goods, with even steeper rates targeting products from 60 specific countries. The announcement triggered a devastating $5 trillion wipeout from the S&P 500, sending American investors into panic mode. But just days later, something unexpected happened. On April 9th at 9:37 a.m., a curious social media post appeared, "This is a great time to buy GGT." Hours later at 1:18 p.m., a sudden 90-day pause on country-by-country tariffs was announced, though the universal 10% tariff and levies on major trading partners remained in place. The market response was immediate and dramatic. The S&P 500 surged 9.5% by close of trading. GGT stock skyrocketed, adding an estimated $415 million to the portfolio in a single day. Meanwhile, certain traders who bought the dip made extraordinary profits. Days later, in an Oval Office meeting with NASCAR drivers, there was open celebration about the financial windfall. "He made $2.5 billion today and he made $900 million, was reportedly said about Charles Schwab, founder of the prominent brokerage firm bearing his name. Market analysis shows unusual trading activity immediately before the tariff pause announcement, particularly in zero-day options financial instruments designed to capitalize on same-day price movements. This pattern has fueled speculation that some traders received advance notice of the policy reversal. If you know 2 hours earlier that the stock market's going to go up, what are you going to do? You're going to buy a hell of a lot of stock, noted one financial commentator. The situation prompted senators to request an investigation from the Office of Government Ethics, warning about the unique position of government insiders to exploit non-public information. Tesla stock, for instance, jumped 18% after the announcement, raising questions about potential conflicts of interest. But did these actions actually violate securities laws? To answer that question, we need to understand what constitutes illegal insider trading. What makes insider trading illegal? Insider trading occurs when someone trades securities based on material, non-public information. While some insider trading can be legal with proper disclosure, it becomes illegal when a person trades while possessing material non-public information in breach of a fiduciary duty or relationship of trust. In exchange for personal benefit with knowledge of wrongdoing, information is considered material if a reasonable investor would find it important enough to affect their investment decisions. Information is non-public when it hasn't been broadly distributed to the marketplace. The breach of duty element typically applies to corporate insiders like directors and employees, but can extend to outsiders like service providers and family members who receive tips. Crucially, the government must show the tipper shared information for personal benefit and that the recipient knew rules were being broken. Consider the famous case of Martha Stewart, who sold nearly 4,000 shares of ImClone Systems just before the stock plummeted. While this appeared to be insider trading, prosecutors couldn't prove Stewart knew the information was material and non-public with the necessary intent. Instead, her conviction came from lying to investigators and attempting to cover up her actions. Who might be implicated? Looking at the tariff scenario, 4 groups could potentially face scrutiny: executive branch employees, cabinet members, friends and family, and members of Congress. Federal employees operate under strict ethical guidelines. Regulation 5 CFR Section 2635.703 explicitly prohibits them from using non-public information obtained through their government position for personal gain. Violations can result in suspension, demotion, or removal from service. Cabinet members face even stricter oversight under the Ethics and Government Act and the Stock Act of 2012, which requires disclosure of trades within 45 days and clarifies they can be prosecuted for insider trading. Friends and family without government positions aren't bound by these specific regulations, but could still face insider trading charges if they received and acted on material non-public information. Members of Congress are subject to the Stock Act, which bars them from using non-public information gained through official duties for personal financial benefit. After the tariff announcement, Representative Marjorie Taylor Greene reportedly purchased between $21,000 and $315,000 in stocks, including Apple shares, days before the tariff pause. While she stated these trades were made by a financial advisor under a fiduciary agreement, many of these stocks rebounded sharply after the announcement. Despite the Stock Act's requirements, its enforcement mechanism is notably weak. Violations of disclosure provisions carry a maximum fine of just $200, and no member of Congress has ever been prosecuted under the act. The presidential immunity problem. When it comes to the president's personal involvement, a familiar obstacle emerges: presidential immunity. While subject to the same securities laws as other Americans, sitting presidents are extraordinarily difficult to prosecute, creating a troubling accountability gap. The timeline of events raises questions. At 9:33 a.m. on April 9th, a cryptic message appeared: "Be cool. Everything is going to work out well. The USA will be bigger and better than ever before." Minutes later came the great time to buy post, coinciding with a small bump in the S&P 500 index. Then at 1:18 p.m., the tariff pause was announced, followed by a dramatic market surge. While these public posts themselves don't constitute insider trading since everyone could see them simultaneously, the 4-hour gap between the early posts and the actual policy announcement provided ample time for those in the know to position themselves advantageously. The case ultimately comes down to who knew what and when. Without evidence of specific communications showing intentional sharing of non-public information, proving insider trading remains challenging. Given the president's weakened inspector general offices and expanded immunity protections, accountability through traditional legal channels appears increasingly unlikely. This situation highlights the profound tension between executive power and the principle that no one should be above the law, especially when billions in market value hang in the balance. Don't forget to leave a comment below with your thoughts on this situation. Subscribe to our channel for more in-depth analysis on legal matters affecting our nation, and share this video with friends who care about government accountability. Together, we can stay informed about these crucial issues.